Today's episode of Hidden Forces is made possible by listeners like you. For more information about this week's episode or for easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription available through the Hidden Forces website or through our Patreon page. And remember, if you listen to the show on your Apple Podcast app, you can give us a review. Each review helps more people find the show and join our amazing community. And with that, please enjoy this week's episode. What's up, everybody? I have two guests with me in studio today. Kevin Smith, Chief Executive Officer and Portfolio Manager at Crescat Capital. Welcome, Kevin. And Otavio Costa, Global Macro Analyst for Crescat Capital. Welcome, both of you, to the show.
Thank you.
Thanks, Demetri.
It's great having you on the program. How are you guys feeling? I was saying that I've heard good things about the experience of coming down to sea level when you're up in the mountains. Your fund's up in Colorado, right?
That's right. We're at in the mile-high city of Denver.
Mile High City. Is it really a mile high?
Supposedly.
Or
5280.
It's just convenient that it's now also the weed capital of the United States.
That's right.
That's true.
So before we start, it's not something I usually say for my episodes, but because you guys are both fund managers, we're going to end up talking about a number of things. Nothing I say on Hidden Forces today can or should be viewed as financial advice. All opinions expressed by me are for informational purposes only. All right, now that I got that out of the way, let's talk a little bit about your histories. Kevin, why don't you start first? Give us your bio and your background and when and how you launched Crescat.
Sure. I'm the founder and CIO of Crescat Capital. Crescat's a global macro asset management firm based in Denver. And my background, I have a degree in economics from Stanford and a degree in finance from the University of Chicago. And I'm a chartered financial analyst with about 20 years of portfolio management experience. I founded Crescat Capital 10 years ago. Crescat is about developing macroeconomic themes to capitalize on things like the business cycle. And we use both equity models and macro models to develop our themes. And the macro thematic investment process applies to all three of our strategies: our long-only large cap strategy, our long-short hedge fund, and our flagship global macro hedge fund.
And Otavio, you?
Yes, so I actually have a much shorter version of his bio because I'm obviously younger, but I moved to the U.S. in 2009 or so to play tennis in college back in the days, and so I went to Liberty University at D1. I got recruited to play tennis there, and then I moved back to St. Louis to a private school, finish up college, moved to Denver, met Kevin, and have been working for Kevin for about 6 years. And my focus has been mostly on global macro research. So my research has been kind of featured on places like Wall Street Journal or Bloomberg, and just been helping Kevin to build what we call the Crescat's macro model and some other things that are in line with evolving our investment process in general.
So we'll get into the macro model. That's something I'm interested in discussing about with you guys. Before we do that, what is your outlook for global asset markets, and how long have you had this view? And how has it evolved, I suppose?
I'll start with that. This is Kevin, and we really believe that we're at record valuations for the U.S. equity markets, and we've been there for a couple of years already. It's only gotten more overvalued. And we're record late in the business cycle. We're 10 years into this economic expansion, which has just exceeded the 1990s economic expansion by one quarter. So we're very concerned that across 8 different valuation metrics in the U.S. market that we're at record valuations, and we can get into some of those if you're interested. And we're really trying to express that through a tactical short position in our global macro and our long-short hedge funds. If you think of our hedge funds, there's really 3 major themes that we have today to try to position and capitalize on our tactical views. And those 3 are really short global equities with a heavy tilt towards U.S. equities, long precious metals, and we have a China credit bubble thesis also where we're short the Chinese yuan.
Mm-hmm. Well, I should also mention you guys have gotten a lot of positive press recently because two of your funds, the Global Macro Fund and the Long Short Fund, generated 41% and 32% returns respectively. So, kudos to that.
Thank you.
I am interested in going into your macro fund, into your macro model. But before we do that, I do want to ask you guys about, I think it was yesterday, the markets closed at above the previous high that they made in December, or not in... When was the last high they had made in September? When was
September,
it?
yeah.
September, right. And then they bottomed out in December, and they recently paired all those gains. Are you concerned at all at the ferocity and speed and temerity of the rebound?
It's been quite a rip-roaring bear market rally, we think, that has only retested the highs that we reached back in September. In fact, if you look at it, it's really what we think of as a triple top. A bearish triple top, starting with that first top that we had in January of 2018, after which we had the Volmageddon, if you will, where volatility products started to blow up in February. And we really think it's a combination of record valuations and a record late cycle. And now we're doing this triple top that it's just hard for us to understand how it can be sustainable given the underlying fundamentals that are deteriorating.
Well, I mean, I say that also because you could say arguably we've had three of these pullbacks, certainly two, 2011 to 2012 and then 2015 to 2016. Let's take 2015 to 2016. What is the major difference besides duration of the recovery and the duration of the bull market between that period and today?
Yeah, we hear a lot of investors kind of supporting their bullish thesis on a possible soft landing scenario like we had in 2016 after the correction that we had in 2015 and with the Fed pausing its rate hike cycle that kind of extended the business cycle. But this time is actually very different than 2016. And one way you can look at that is looking by credit markets. And if you look at credit markets, which tends to be a bellwether for stocks, at least historically, what we find there is that you can look at the percentage of inversions in the yield curve. So how do you calculate that? You looked at all the possible spreads that are in the yield curve. So all the way from 30 versus 10s and 10s versus 5s and 5s versus 4s. And you calculate all the possible spreads. And what you get there is that close to 50% of the yield curve is inverted today in the U.S. And that's just as high as it was at the housing peak and the tech bubble peak as well. And if you look back in 2016, that number wasn't even close to not even, I think, the 20% level. That's not to mention some other macro indicators we're seeing today that looked a lot more extreme, aside from our macro model being at 2 percentage points from record overvalue levels. Valuations just reached just kind of absurd levels, not just in public companies, but private equity companies too. But, we can go into other macro indicators, but the situation today, given what Kevin was saying about valuations and the macro kind of all this macro indicators lining up today to what we think that it's going to be unfolding in a very severe bear market and a recession.
Yeah, we'll go through them. I mean, especially consumer confidence. I think that's one that doesn't get enough mention. Obviously, the yield curve inversion is probably the most cited indicator. Do you ever worry that given the financialization that we've seen in the U.S. economy over the last 4 decades and the chronically lower interest rates with every business cycle, we've had ever lower rates, and also the forward guidance, the coddling of expectations around interest rate hikes in order to smoothen out volatility, that this has dulled, first of all, it decoupled in some sense the relationship of price, asset price, to underlying value. Maybe decoupled is a strong word. It has distorted, certainly, but also perhaps decoupled in some sense, and that it has dulled the effectiveness of these indicators as tools for anticipating a recession or anticipating a bear market.
Well, I think, typical with the tops of business cycles and the tops of markets, there's always a chorus of people trying to explain why it's different this time. And certainly there have been a lot of bears over the past several years who've tried to call the market top. And obviously we've been disappointed. And this is a cycle that has extended longer than any other in terms of both the bull market and the economic cycle. But what we have today is record global debt to GDP. And so this lower and lower interest rates for longer and longer has only fed more and more leverage to go along with this record valuations. And we really don't believe that it's different this time. We believe there is a business cycle. And
are you sure about that?
And We don't know exactly what some of the external shock type catalysts are going to be, but if we had to make some bets about where we think they might come from, we think China is certainly one of the biggest credit bubbles out there in the world today, where there's a big misperception about the ongoing ability of China to continue to grow. China's been more than 60% of global GDP growth since the global financial crisis. And really, it's just an enormous credit bubble that we think is one that is ready to burst and be one of the shocks potentially that is the catalyst for this downturn.
I think now a little bit back to your question on one thing that we do at a Crescat, which is part of the investment process, is to build models, as Kevin said. And, is the fact of acknowledging, and we get a question, a common question is, what is the one factor you're looking at that will tell us when the business cycle is going to change? Well, there isn't. What we do is we look back in history and we try to accumulate as much as we can of macro indicators that have worked in the past and previous business cycles and kind of accumulate all of them in one place. And it's really the idea of building models like that. And, by doing that and looking at what's the statistical correlation of those indicators with the changes in the market would at least kind of help us to know where we are in the cycle today. So our best job is really to keep on validating this thesis. We joke around that we would love to see, a macro deck like ours of 50 charts or so of showing, a bullish case for the markets in general today. We do have over 50 charts to prove anyone that, that we're very late in the cycle here right now. And perhaps in the near term, we're likely to see what we think it's going to be a severe bear market.
So let's go through some of these indicators. I mentioned consumer confidence versus present reality. That, I think, is an important one that is not often discussed. You have some other ones as well. I don't know if you want to walk me through some of them or if you want me to pick and choose.
Sure. So for the macro model, the idea of the macro model that, again, we do several models in the company, but this one was the one that we decided to publish. And we decided to publish it because, first of all, it's simple, it's easy to understand, but it also has worked very well in the past when you back tested it throughout history. It goes back to the 1987 or so. But, it includes a few things like the rate of change of the Federal Reserve rate hikes or just the consumer confidence.
Tell me about that one.
Sure.
Tell me a little bit about that one.
Well, the Fed usually tends to hike the economy into a recession, usually at extreme valuations. We've seen this throughout history several times. What's the number? 13 times that the Fed raised rates in a cycle, and
nine out of the last 12 Fed rate hike cycles where the Fed has paused and then ultimately reduced rates have led to a recession. The only 3 times that it didn't lead to a recession was only 3 years into an economic expansion.
How many of those times was the Fed hiking into the recession, and how many times did it pause? And were there any times where it actually began to ease?
That's a good question, because when you look at it on average of the last 9 recessions that we had, the bear market actually started an average of 2 months before that last Fed rate hike that ended up being a pause and ultimately a reversal. And the recession started an average of 5 months after that last rate hike. So if you think about it, the peak of the market back in September would have been 3 months before the Fed pause. And if that was the peak, even though we're retesting it now today, the recession on average could start as soon as next month.
You think it started already?
Well, I don't think personally that the recession has started yet here in the U.S. I think we're close. Really, what you tend to see is the bear market happening first and then the recession following it. And the bear market started to happen in the fourth quarter, but here we are retesting the highs with this triple top. So I think we need to see another market downturn. But even when the recession actually starts, you don't know it officially until probably several months or even a few quarters after it officially begins, because then the past economic data tends to get revised downwards.
So speaking to that point, how many of these indicators are forward-looking indicators? And how many of these are basically for timing the market? And how many of these are valuation indicators that you're using to basically determine whether stocks, for example, are over or undervalued?
Well, for the macro model, you have unemployment rate. Usually the U.S. economy tends to be at its lowest unemployment rate at the peak of a cycle. So that's actually also an uncanny relationship with the business cycle changes. The consumer confidence is another one that also tends to be at extreme highs every time at the end of the cycle. Corporate spreads tend to be at very low. So you add up all this, and you have also just the inversions of the yield curve that, sometimes we had other periods that took a little longer for those yield curve inversions to really materialize into bear markets, and some others actually precisely time time the business cycle. So, by adding all that together, it's hard to say. I think most of them, the economic indicators are, I would say a lot of them are forward-looking, and the valuations are not timing indicators per se. The technical indicators are. We have a few just to show how extreme we are. Let's say S&P 500 levels relative to 200-day moving average of the S&P, and it's just a very simple way, and it's not very complex to calculate that. And when you look at that throughout history, and you see that that is extreme, in line with valuations, in line with all these economic indicators, and volatility being at all-time lows, well, maybe there's something there that we shouldn't be taking too much risk, and we should be more defensive and taking a more defensive stance overall.
So I think, did you want to say something, Kevin?
Oh, yeah. I mean, that's a good summary of the different indicators. And I would just say that I think about half of them are valuation and imbalance type indicators like debt imbalances, and the other half are macro timing and technical type timing indicators.
So debt, there are a few things I want to talk about. One, actually, this trade of the century that you guys refer to it, which is going long gold in renminbi terms and going short stocks. I do want to get into that, but you mentioned debt. Again, it's the second time you mentioned it. This is something on this show and on my old television show that we talked about ad nauseum. There's no question that some can dispute that there's a distinction between public and private and which one is more pernicious and is public debt really a problem, et cetera, et cetera. But certainly the growth in liabilities as a substitute for real economic growth is a real problem. Mm-hmm. I wonder, because your thesis, and this kind of ties into what you're saying about gold, it sounds like from what you're saying in terms of going short stocks, going long gold, and from some other things that I've read, that you're expecting a sort of stagflationary environment, something similar to the 1970s. Is that right?
Well, it's certainly a possibility. In the last business cycle, we really never saw inflation get going or take off. And even now with interest rates likely to be coming down again rather than rising, with the Fed more likely to ease than continue to hike.
Just to clarify, when you're talking about inflation for the purposes of this conversation, you're referring to consumer price inflation. You're not describing asset price inflation.
Exactly. We're talking about traditional consumer price inflation. And what we've seen with record low interest rates and Fed stimulus, central bank stimulus in general, is asset bubble inflation and debt inflation. And so we have record global debt to GDP levels. We have record asset price bubbles in stocks and corporate credit.
And, huge.
And so we've seen asset price inflation, and we've seen what happens when asset bubbles burst, too, during the global financial crisis. And, people thought that we were going to see inflation in that crisis when the Fed started printing record amounts of money. Gold really started to do well in that crisis from 2006 to 2010. The gold to the S&P 500 ratio increased by 300% during the global financial crisis. And central banks continued to print money, and gold continued to rally all the way to 2012. But what happened was inflation never really took off. And so from 2012 forward, gold actually has been in a bear market.
Well, do you think that gold is a hedge against inflation? Because we've had inflation pretty much nonstop for decades, right? It's been moderate inflation, but gold declined all through the period of early 1980s to 2000. Mm-hmm. During the 90s, we had inflation, right? Mm-hmm. Or is gold really a hedge against credit risk, or maybe existential risks that you can't identify? And that sort of brings us back to this problem of the debt and this larger problem, I think, that we'd all agree with, which is that we live in an extremely unnerving environment. Anyone who would consider themselves to be remotely cautious has been, I think, invested with a level of anxiety. Right? Mm-hmm. Because also safe haven assets aren't what they used to be. Mm-hmm. So it's not clear what a risk-off trade even is. And so I wonder, to what extent is gold really a way of capturing exposure to being invested outside of the financial system in a sense, especially if you're owning physical? And how much is it really a bet on inflation?
Well, I think you can make a whole case on gold without even mentioning inflation today. Just the safe haven aspect of it is what I think it's very important. Obviously, the size of the monetary base globally and money supply relative to gold above ground levels is also an imbalance. But when you have that with all these macro indicators that we see today, I think that just the safe haven aspect is very attractive to us. One one way you can look at that is looking at the 2-year yields in the U.S. So 2-year yields, this nominal rates, they tend to drop significantly. We can get into that later, but they tend to drop significantly when we get into a kind of late stages of the cycle, which is kind of the pattern that we're seeing now. And you can link that back to if you're going to see, we think we have a view that 2-year yields are going to fall significantly as the credit markets start to really price in even more that the Fed is going to have to ease, in the 2 to 3 to 5 year horizon.
So one of the things that we had after the 2008 crisis was there was a period of deflation and then there was a reflation in terms of assets. What you guys are describing, though, if I'm correct, and again, I'm not clear if I got an answer on this, as I understand it, you're looking at a more stagflationary environment in terms of consumer price inflation and a slow growth environment. In that type of environment, are you looking at an initial bout of deflation that lasts maybe 6 months or a year, and then that central banks are able to reflate the economy in a way that they really weren't able to achieve last time around? Last time they got asset prices up, but they really weren't able to generate the type of inflation that they perhaps would have if they did a fiscal expansion, which then can get us into a question of what happens if the Democrats take over in 2020. Mm-hmm. What about some of these theories like MMT and UBI, where they would literally helicopter the money into people's hands? That, I think, potentially could generate inflation, but I'm skeptical about the banking system being able to generate inflation simply through further quantitative easing or lower interest rates. We went down that route once. We have even more debt now. I'm not sure why it would work.
Well, we've done a lot of work on inflation, and we're not seeing a significant amount of inflation rising here in the U.S. as far as, that would be the main reason for driving gold prices higher. We've done some work on the Phillips curve that, perhaps could be starting to work more recently. And I think that, that might be the ultimate answer for how much leverage we have in the system might translate into inflation somewhere in the cycle. But
when you say you see the Phillips curve working, are you saying that the lower interest rates are actually causing an increase in employment?
No, it was just looking at the correlation of unemployment rate and CPI rates, and we saw some significant pickup of the correlation, the rolling correlation of those two indices. I think we posted that in one of our letters maybe 3-4 letters ago, and that was kind of an interesting idea at the time that we thought that rising salaries and wages also were kind of picking up too, and we thought that maybe agricultural commodities could have a rise in prices, but this was all an idea that we had back maybe a year or so ago, and our goal really is the inflationary component of gold would be really the cherry on top of this whole trade. The trade really is safe haven component, and the even more interesting trade is not even gold, is really gold relative to S&P 500, because that's what it tends to work, especially in times when you have things like yield curve inversions. Yield curve inversions, okay, the market can take a while for it to break down in some moments like 06 or so, but guess what? The gold to S&P 500 ratio actually started to rise during that period, exactly when the inversions began to happen during some periods, even in the 70s, the 60s, or 80s. So, we try to rely much more on that part of the thesis than the inflation on its own.
We're not trying to make a bold call on inflation. We're not saying inflation is getting ready to take off, because I don't think we have to right now. First, we need to see the asset bubbles burst.
Right.
Then we need to see the Fed come in with whatever it's going to do next.
Well, that's my question, because that's where I think I'm potentially disagreeing with you, and I'm curious to understand your thinking on it. I do think you could see inflation. First of all, I think you could see anything. Who am I to make that determination? But I fail to grasp how the central bank is going to generate inflation unless, even if it were to go out and start buying equities, that would go right into financial assets, and I don't know that solves the economic problem. Mm-hmm. And so I wonder, have you considered, as part of your thesis, that you think that we're finally going to get a massive fiscal expansion? We didn't get it in 2008, 2009, 2010. We didn't get it, right? Mm-hmm. We got something minor. I forget what the package was. Was it $850 billion? I don't remember exactly what Obama spent. But
right.
Do you see that? Do you foresee that happening, for example?
Well, I think certainly one of the risks right now is that we already have twin deficits that are exploding, going into the peak of a business cycle. That's normally something that you see after the downturn, is the fiscal stimulus come in.
Sure,
and
that's another thing. Yeah, the tax cuts.
But now you have this crazy populism out there where, we don't know if we're going to have a Democratic president, and we could have a much further left type, whether it's Bernie Sanders or Elizabeth Warren. I mean, who knows? When you start talking about free healthcare and free education for everybody, these could be...
Or UBI. The UBI, I mean, that's never... I mean, Medicare is something we've been talking about since... I guess going back to LBJ maybe or earlier.
Mm-hmm.
But I mean, UBI, Universal Basic Income, that's pretty wild. That's Andrew Yang is, I think, the first person to propose it. But others, I think, are open to the idea, and that, as I understand
you're talking about helicopter money.
That is $1,000. That's he calls
was-
it a dividend. That's a $3 trillion
$4 trillion.
addition. $4 trillion.
Yeah.
Okay, so I mean that's a big deal. I think that could conceivably generate inflation, and I think it's conceivable that could happen.
But it's just crazy to think that somebody's even, not even getting political. I don't want to get political, but just the thought of considering that just goes to show that we've been in this world that nobody really knows what the inflationary forces really are when they get going. I mean,
that's a good
historically
point.
We've seen it. But there was one part of inflation that for me, that's why it's harder to make a point on inflation is our views on the Chinese currency. If we think that the Chinese currency will devalue significantly, because of the credit situation, I think that's a massive deflationary force. Wouldn't you agree?
Mm-hmm.
I mean, it's hard to have a strong case for inflation if such a major importer of goods like the U.S. purchasing goods from China. If there is really a major devaluation of the yuan, I think that would be shooting down completely the whole thesis of inflation. So I think that's a part that we struggle with to really reconcile the whole thesis.
And so for us, really, we're trying to express the deflation of the asset bubbles first in terms of our short positions on U.S. equities or the China currency, for instance. And once we see what the response is and what the political situation is, we'll be able to have a much stronger view about inflation, going forward. But including gold, which, it's that safe haven component that's going to act first before the inflation component even comes into play.
Exactly. You have so many variables in this environment. I would think it's fair to say that there are many more variables today than there were in 2007, 2008. And back then, they were more confined within the normal parameters of financial markets. Today, they're really existential. They could involve nuclear war. They could involve all sorts of things. And that's why I think also gold acts as a really great hedge against credit risk and against sort of existential risk. But to bring it back to this thing about currencies, you mentioned China. You also have Hong Kong and Saudi Arabia here as having devaluation risk, right? These are overvalued in your estimation. You aren't the only ones. We did an episode with Ann Stevenson Yang last week where we talked about the renminbi dollar peg and how that could all come apart. And it sounds to me like you guys are concerned about this as well, that the renminbi is overvalued and that we could see a major devaluation in China. What does that do? You were basically getting at, Otavio, for deflation, global deflation. And our guest last week basically said she thinks that would lead to the United States raising tariffs even further and to China basically piecing out of the international trading system. How far down have you gamed out these scenarios? How much do you think about this? Because you've spent a lot of time discussing China, and I should also mention to listeners, I did read your Q2 2017 report. I thought it was actually very good. So in line with a lot of what you've written, I'm curious if you would care to expound on that here. It's been 2 years since you wrote that report, and you've written some stuff recently, but I'm curious where things are today in your view.
Sure. Well, that China report that you're referring to, we actually started getting short the China yuan maybe 3 years ago or more. And so this is a theme that's been developing a long time. It's like one of those imbalance themes where the timing is much less certain and the imbalance just keeps getting bigger and bigger and bigger. So China has created $45 trillion worth of credit in its banking system. Since the global financial crisis, it's been 400% growth of banking assets. And a lot of this credit has gone
Huge,
to...
ridiculous credit growth.
It's unprecedented.
Alarming, freaking out.
Unprecedented. It's a bigger imbalance than the European banks ahead of the European financial crisis. It's a much bigger imbalance than the U.S. financial bubble ahead of the global financial crisis. And given that China is a totalitarian communist country, it adds a whole other dimension to the currency risk. So we think there's an enormous non-performing loan problem that's just been getting rolled over in the Chinese banking system, extend and pretend. If companies can't pay back their loans, just loan them more money. That's been going on for a decade. What's the catalyst to burst this bubble? Well, one of the catalysts we think is the trade war with the U.S. and the Trump negotiations that have been dragging on for a long time already. A lot of people think we're going to have a rebound in the global economy in the second half, and that this China stimulus that we've seen recently in the first quarter is going to lead to that. But we think there's much bigger problems in the Chinese economic system today. The 40% correction that they had across their median stock last year is basically a recession level type of a market correction. And even with the 40% surge in credit in their total social finance that we saw in the first quarter, nominal GDP growth was only up something like 5%. And that's GDP growth that we can't even believe, that has been declining consistently as more and more credit has gone to generate less and less GDP growth. So we do believe that China is approaching that Minsky moment of this credit imbalance.
Well, it's a fragile equilibrium they've got there with their current account and their excess reserves and their fiscal balance and everything else, and their really tight capital controls. It's nothing like what Western financial systems are, right?
No, not at all. And you have all this pressure from money within China trying to get out.
Right. A lot of capital flight, illicit capital flight.
Illicit capital flight, money laundering. The banks themselves are likely complicit in it.
I'm curious, how do you guys, I struggle with China tremendously. Like, this is probably, if not the most difficult subject I've covered on the program, it's the one that gives me the most heartburn, because you don't even trust the numbers. On top of that, I haven't been to China, and I'm not Chinese. I don't speak Mandarin, so I'm only willing to say so much. I have a friend a friend of our show also, Jim Grant. He says one's expertise on China increases, exponentially based on your distance. I forget how he said it, but basically, it's easy to opine about a country you know nothing about, and that qualifies in the case of me and China. But it's so challenging because how do you know what to look at? What data do you look at, right? So how have you guys dealt with this challenge, the lack of trustworthy data coming out of China?
Well, there are a lot of ways. One way would be the current account not per se is trustworthy, but it's definitely more trustworthy than the other types of data that China puts out. And I think that one is other managers have been kind of using that as the big argument for why.
You said the current account, you said?
The current account of China. The current account is an interesting factor because the current account of China has been shrinking significantly since the global financial crisis. And if you looked at countries in general, when they have a situation like that, usually that tends to add pressure to your currency. You have cases like Argentina that loses, that kind of lost 90% of its currency value since the global financial crisis. And then you have, places like China, in which, it's actually kind of the opposite. China is the only country in the world that its currency actually appreciated, even though its current account actually shrank significantly since the global financial crisis. But I think the other thing is looking at the illicit capital outflows of China from the elites and so forth. And you can kind of see that by looking at Canada and Australian housing markets. I think that, the kind of the derivatives of
the commodity economies.
Well,
exactly. You guys have had some outstanding short positions on Canadian corporates and banks, as well as the housing sector too. Is that right?
Yeah, it's kind of a derivative from the Chinese theme initially. But if you looked at those two economies, as far as the housing bubble, it resembles quite a lot the housing bubble we had here in the U.S. back in 06, 07, and 08 when it started to burst. And I say that in a lot of ways, not just, it's the leverage in the system, the leverage in households, the level of leverage there is quite high. The leverage in the country overall, just leverage, what I mean by that is household debt relative to income ratios. And at the same time, you have, extremely high house prices. And you can look at the BIS and the IMF numbers. They put out several numbers on price to income ratios and price to rent ratios and credit growth, just specifically on housing. And you can see how really this bubble has been kind of developed. But it's not the only thing. You can look at valuations of the banks. The valuation of the banks also resemble the valuation of the banks here in the U.S., and it's, a lot of those banks actually peaked in 2018, but it's actually very, very similar.
Canadian banks.
We're talking about Canadian and Australian banks.
Correct.
And Australian banks. So I was going to bring up, because Australia hasn't had a recession for 25 years? What is it, 22, 25?
I love that argument.
I'm not making that argument. I'm actually...
sorry.
No, I could add on top of that, but my point was just to say they haven't had one yet. They've gone this long. Also, Canada didn't have one. Did they have a recession in 2008?
Yeah.
They did?
Yes.
How long did the recession last? Do you know?
I don't know.
It's okay.
I don't know, but they were caught up in the global financial crisis.
But their housing market didn't really decline, right? If I remember correctly, their housing market didn't really take a hit.
Correct.
No.
Remember correctly? And of course, Australia's didn't. And many people were out ahead of 2008 calling for a collapse of Australia's housing market. It never happened. So I think that is, again, the problem of timing. Now, we're talking about China again. This is, the Chinese in particular have the tools to prolong this much longer than a liberal Western economy, right? This brings, again, back to the problem of timing. We all see this stuff. Well, not all of us, but certainly those of us sitting here at this table, we see this premonition. We can feel it, but it's gone on for longer, I think, than many of us expected, both in the U.S. and in China and other places. And again, the question really is, what is going to be the catalyst? And for you guys, you think the catalyst will be China, and the China catalyst will be the trade talks. So you're looking at something kind of in the next sort of 3-6 month period, basically in 2019.
Well, the catalyst for the unwinding of a Ponzi scheme, really, when it comes to any type of a Ponzi scheme, Hyman Minsky was an economist who came up with this idea of Ponzi finance systems where you're unable to service your debt with underlying cash flow. And China, that's been the situation now for years and years. And the imbalance just keeps getting bigger and bigger. But what ultimately makes a Ponzi finance system come unwound, and that's what people refer to as a Minsky moment, which was labeled in the financial crisis.
Stability that begets instability.
The financial instability hypothesis. And so ultimately, debt bubbles implode on themselves when they can't be serviced. But it does take some kind of external catalyst. The trade war with the U.S. is just one likely potential catalyst to potentially unwind that Ponzi scheme.
It's easy to get caught up thinking in nationalist terms. This is a global economy. And I bring that up in the context of gold, right? How much demand do you think is going to come from countries like India and China? And also, maybe you can further answer that point by telling me how you're investing in gold. Are you allocating towards the miners? Are you buying physical? Are you buying futures? Are you in ETFs? How are you invested in gold?
All the above. But I think that as far as demand goes is, if you do a lot of research on how credit bubbles burst in emerging markets especially, it's kind of interesting because usually you can have, a bust or collapse in equity markets, or sometimes you can just have a collapse of the currency and actually the equity markets rise in local currency terms.
Right.
But the one pattern you find throughout history is that gold prices in local currency terms tends to rise. We looked extensively throughout history to see this, and it's a very usual thing that happens. And that's why we came up with the trade of looking at gold in yuan terms. I think we're very likely to see a rise in demand of gold in China itself, and I think that's just probably going to be a big part of the whole case.
Global central banks have become net acquirers of gold again in the past several years, and gold is the longest running central bank reserve currency that there is, even though we're not on a gold standard anymore. Central banks still own gold. And when we get into the financial crisis, we think there's a high likelihood that we also have the rush to gold from individuals again. In terms of central banks, yes, China and Russia have been two of the net acquirers of gold recently. And if the Fed wanted to get back into the game, that would be probably the easiest way to create inflation. If that was something that the Fed was trying to do, just start buying gold again. That'll
make a lot of people happy. That would make me happy, probably, to be honest. But let's switch back to corporates, because you mentioned those earlier, and we didn't really have a chance to discuss them much. This is a crazy, crazy time to see what's happening, whether it's Lyft, the Lyft IPO, which gave me some faith in humanity. After the initial public offering, that maybe we're coming to our senses, or maybe things aren't, go stratospheric. But Tesla's another example. I mean, it has been remarkable to see what cheap capital has provided and made possible, to say nothing about the unicorns, right? Whether it was Lyft before or Uber or so many of these crypto projects that were able to raise incredible amounts of money. What is your outlook for corporate debt? You mentioned corporate debt. What is your outlook for corporate debt, and how do you see the last 10 years having impacted the profitability or survivability or flourishing of corporates despite, let's say, the lack of adequate profitability or profitability period? Yeah, take that however you like.
Sure. I think the corporate debt is obviously a huge problem, not just the leverage ratios being at record levels. But the one thing that we put out that I think it's going to be interesting to look at is we looked at the percentage of companies by countries that are losing money on a free cash flow basis. And this is non-financial stocks. And so it's public companies in general. And what's interesting about that is you have places like Canada, 82% of all the stocks, non-financial stocks in Canada are losing money on a free cash flow basis. 71% in Australia, about 60% in the US and China, Hong Kong, Singapore. All those places are about the 60% handle. I mean, it's kind of, this idea of the whole market being propped up by central banks and this ultra low interest rate environment. I think companies like that would never be able to survive in an environment that would be more normalized, especially for cost of capital. So that's kind of
So that's interesting. Let's actually talk about that a second, because this word unprecedented gets thrown around a lot, right? The public debt is not unprecedented. We've seen that before. We've seen it during wartime, and we've seen all sorts of, governments do all sorts of crazy things over the millennia. I don't think we've ever seen this. Have we ever seen this many companies that are able to be listed, survive, and not generate profits or free cash flow? I'm asking it just in my head
because,
because
of course, we saw that quite a bit with the dot-coms.
Yeah.
We did, but there was a real growth story there, right? Underlying all of that. What is the growth story today? Do you know what I mean? There was a narrative for those stocks back in the late 90s. What is the narrative today? What is the narrative behind Tesla and Uber? I mean, Tesla...
The narrative today is that everyone is going to be the next Amazon. But there's one Amazon that was able to ultimately find a way to monetize its business and to produce free cash flow. But not every company is going to be a disruptor in that way. Everyone is trying to be a disruptor, but you can't just acquire clients by cutting your prices and expect that you're ultimately going to be able to turn that into a profitable business.
It just feels like we're in the sort of hangover phase. Like we had this epic party, and that was the 90s. And that we're kind of in this phase now where we're trying to sort of wind down by taking some uppers, but it's just not the same thing. You know what I mean? It just feels like that. I feel like the debt has facilitated that because that mania is not there. I don't know exactly where it was that I was looking at some numbers and I was thinking about this. I don't know if it was the consumer confidence numbers you had out there, but you can't compare today at any point during this. First of all, we don't even have the same level of economic growth that we had in the 90s. We also have so much more debt. It's just not the same type of a landscape. And yet the state of corporate balance sheets seems more impaired, although, again, you've made a good point about the late 90s and PE ratios were even higher then, I believe, right, than they are today. So that, to me, is a crazy environment to look at.
I think, you mentioned Jim Grant, and he interviewed Barclay Leib on his podcast a few weeks ago, which I think Barclay Leib was the one who said that was very interesting, is that since the 80s or so, the crises are getting worse, right? So you had the 1990s, and then you have the tech bubble, and then you have the global financial crisis. And maybe, I kept thinking about this. He didn't really elaborate much on that besides making that comment, which it's a very good point. But I think it has to do with the amount of leverage in the system that just keeps accumulating over time. And people are getting used to money printing in levels like 4 trillion is nothing and 3 trillion is nothing. And now you have China just, keep printing money and keep the party going. And until things will reconcile, that I think we have a very high conviction that we must be at the very end of this cycle.
We've also transformed and broken, I would say, the economic model, because with each one of these cycles, we're transferring ever more wealth out of a larger percentage of the pie, right? What is it, 60% of Americans now? Am I correct in this number? If you don't have it, that's fine. I can't get it off the top of my head, but I think it's 60% of the country has either no assets or negative assets. In other words, they owe more than they even have, right? I mean, that's a fundamentally unworkable problem. And what happens if we have another credit crisis? Does that become 80-20 as opposed to 60-40? You know what I mean? Wow. So anyway, let me ask you one more thing. You guys have a number of themes here in one of your recent reports. Some of them we've already discussed, like Aussie debt crisis and Canadian housing bubble. We didn't really get into European disunion, but I think we've covered that enough on the show. I like this one here, reefer madness. I'm curious what that refers to. Is it maybe going short marijuana stocks? I can imagine. I saw actually I was at the Robinhood Investor Conference in September, and there was a guy there that gave a really great presentation on this. And talking about Canada, I mean, there you go. Genomic revolution, I'm curious to hear about that. Security and defense, is this security or cybersecurity? What is cybersecurity?
That's really become more of a cybersecurity long theme for us recently.
Tell me about that one. How are you investing around that theme?
That's a long-only theme where we're investing in about a handful of cybersecurity stocks that actually score really well in our fundamental equity model in terms of valuation and economic growth. A lot to do with the China cyber hacking and intellectual property theft and so forth. I mean, we've seen cyber hacking really on the rise, and we just think there's going to be ongoing demand for security software and services. And there's a handful of companies there. I can mention names if we can't mention individual short names, but we can talk about long names.
So we could discuss that. This would probably be a good time to switch into the overtime, because I also want to ask you about your long gold in renminbi trade and how you're doing that. And I also want to ask you about, because you guys have a chart on U.S. Treasuries versus German bonds. Mm-hmm. And I'm curious if you're investing around that observation, around a narrowing spread. So I want to thank you guys for being here for the full episode. If listeners want to learn more about your fund or your approach, how can they do that?
We have a website. It's crescat.net, and you can go and subscribe to our newsletter there. We're also very active on social media, mostly Twitter and LinkedIn in particular. Tavi, what's your Twitter handle?
At Otavio Costa.
And I'm at Crescat Kevin.
Okay, great. You guys are big Twitterers or tweeters,
yes,
or whatever you call it?
Well, we just figured out that, putting out research as being very beneficial, not just the feedback from the research and just exposure. It's how we are able to kind of expose ourselves to articles and put our names out there with good ideas that we think are good ideas. And
yeah, you guys have gotten a lot. I mean, there was a lot of buzz around your fund. I don't know how much of that had to do with, I'm sure a lot of it had to do with your performance last year, but I was seeing a lot of stuff on social media. Just don't get too sucked into it, because I feel like people end up doing too much tweeting and not enough analysis. And then you get Twitter head. Yeah, so stick around, guys. For those who are regular listeners and subscribers, you know the drill. For new listeners or people who haven't subscribed yet, just go to hiddenforces.io/subscribe, and you can learn about our subscription, or go directly to patreon.com/hiddenforces, and you can learn all about our audiophile, autodidact, and super nerd tiers, where you can get access to this week's rundown, as well as a transcript to the conversation and the overtime that we're about to record with Kevin and Otavio. Thanks again, guys.
Thank you.
Thank you.
And that was my episode with Kevin Smith and Otavio Costa. I want to thank both of them for being on my program. Today's episode of Hidden Forces was recorded at Creative Media Design Studios in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription, available through the Hidden Forces website or through our Patreon page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.